I'm in this beautiful, sprawling university campus in Pune, the Flame University, which is founded by one of the legends of the Lal Street, Nimesh Shah. And on the sidelines of an investment program for executives, I'm talking to a lot of market veterans who are present here to address these classes. I have with me right now a very tall personality, literally a tall personality. Also, his investment stature is tall. Sunil Singhania of Abakkus Asset Management. Thank you so much, Sunil, for joining me.
Pleasure.
First of all, what brings you here?
I think, as you rightly mentioned, it's a legendary Nimesh Shah's university. So I think it's the love, respect for him as an individual, and the fact that he has created this wonderful university in India. I think if we have many more of these kind, I don't think anyone would need to go abroad to study. It's such a nice complex. So I think this program has been going on since 2012. And I have visited this program almost every year since its start. So it's I just love to come here.
You've been one of the most bullish voices in Indian stock markets forever, and definitely after the pandemic, you've been a very vociferous India bull. Now, this election, before the election, if you rewind a bit, there was a lot of expectation that this government will come back with full force, char so par, definitely more than 2019. In that sense, the outcome was adverse. But the market has shrugged it all off and we are hitting new highs. What gives? Does it make you nervous? Is this pragmatism by the market? Is it exuberance at play? How do you read it?
So obviously, the first thing is events are always anticipated. And in isolation, every event looks like moving the markets on either side by a lot. But market is a combination of lot of events and lot of things put together. So obviously, the outcome of the election was slightly lower than what the market expected, but not by much. I think before the exit polls, the markets were expecting anywhere between 300 to 325 for the ruling NDA. We ended up having maybe a 10% lower number, but it's a strong coalition. And I think the voices which came in from the key coalition partners were all towards growth, development, stability in the government. And even the Honorable Prime Minister continued to say that we are moving towards Viksit Bharat, which is developed India. That was the first thing he said when he made his speech after the elections.
Correct.
So I think the market is really confident that the trend and the path which we have taken towards growing at maybe a 7.5% growth rate, moving towards a $7, $8, $10 trillion economy and probably towards a $20 trillion economy over the next 15-20 years stays intact. And I think that is what the enthusiasm is all about. Obviously, there are always excesses in bits and pieces or in pockets. I'm very sure that there are even now, you can clearly see it. So while admitting that there are pockets of, you can call it euphoria, over-enthusiasm, some flare-up, I think overall there is still optimism both from an Indian economy as well as the equity markets perspective.
So we'll come to the excesses part a little later. But before that, we have another event coming, which is the budget. What is your expectation? What do you think is the general market expectation? And keeping that in perspective, what will wow the markets? What will disappoint the markets?
So one, again, thing post-election, the event which was to be sort of tracked was the allocation of ministries.
Correct.
And I think it's been business as usual. In fact, that it is more than what the market expected in terms of continuing at least the key ministries, whether it is finance, whether it is defense, whether it is railways, and so on and so forth. I think from the market perspective, I don't think the market is expecting too much on the taxation front. One thing which has been put to rest, at least it seems to be the inheritance tax, which used to be always a sort of a question mark, big question mark before every budget. The second thing is any changes in gains, capital gains tax, whether it is long term or short term. So I think that is one thing which the market would be looking at very closely. That also seems a very low probability that there would be any change. And I think that is something which the markets would be looking at with optimism if that happens. The two things which the markets would look at is one is the part 2 fiscal consolidation. So whether this whole talk about that the mandate is slightly lower and that's why the government might do a little bit more sort of a populist kind of a measures that would get reflected in the fiscal position. I think so fiscal deficit and the path towards bringing it down to the government stated objective of 4.5% in the very near term, that would be one thing. And second is, in the 23 budget, we had an allocation of 10 lakh crores for infrastructure.
Yeah.
In the interim budget, it got increased to 11,000 crores. I think if the statements come that this is going to be a path going forward, then the markets will get very enthused, because then over the next 5 years, you're looking at almost a 65 lakh crore being allocated by the government in terms of the infrastructure spending. So I would say these two would be the major things which would be looked at. Rest is all going to be more statements, whether it is Make in India or railways or, allocation to
but
solar
that is
and so on.
Hyperbole, we can set it aside.
I think these two would be the main things.
So 10-15% capex spend increase, is that what the market will
I
look
think
at?
10% every year
Over
the next 5 years would mean 65 lakh crores over the next 5 years, which would be incidentally much more than the last 77 years infrastructure spending put together.
And because even last year, there was this expectation that we will do more, but I think we did 10% or 11% more than the previous year. So there is some kind of pullback compared to the, first 2 years after the pandemic. Because there is a hope that, private sector, in fact, Finance Minister last year also made the statement that, government has done the heavy lifting post-pandemic. Now it is time for private sector to come up. So now there are voices which are already saying that, after the election outcome, money will be spent more on consumption and, other things, and infrastructure may take a backseat. Is that possible in your mind?
Both will go hand in hand. So I would say last 2-3 years, the heavy lifting has been done by government spending and infrastructure. Consumption has lagged. Maybe it was because of inflation, because of what was happening on the rural side and all. We do expect consumption also to pick up. A combination of maybe some largesse given by the government. Post-elections, normally the election spending comes into the system. Monsoons are expected to be normal. There has been an increase in minimum support prices. So I think we do expect consumption to pick up. But infrastructure spend will continue. And I would say the private sector is also waiting for some clarity on the election front. We are very confident that private sector capex will also pick up. Because if the economy has to grow, I think across sectors, whether it is steel, cement, utilities, power or any consumption, you need capacities now. And the capacities are also now needed because India is also emerging as a major possible export, or I would say a manufacturing destination for exports. Because the China plus one is a reality. There have been reports which have come in which shows that India is among the top 2-3 countries which will benefit out of a move towards or away from China.
Right.
So we do expect private sector capex to come in. Already a lot of multinational companies have set up, shop in India, including the like of Apple.
Correct.
We are very confident that others will also, in the near term, set up shop in India, including the likes of Teslas, who have already publicly mentioned, and many others. I think the fact that we are also looking at, setting up fab units like semiconductors, I think that is also creating an ecosystem where right now we are only assembling the electronics, then we would actually be manufacturing the complete set of electronics.
One more question on budget. We move on to more on stocks and sectors and themes, etc. This STT, the industry has also made a representation that the cost, STT can be increased on, algo funds and high frequency funds. So you can have a threshold turnover beyond which it should be more expensive, etc. What's your take? How do you think the market will react to any hike in STT? And will that be welcome change or not? Because everybody has been raising alarm over this excessive speculative trading that is happening on the F&O segment. And we put out a story only day before yesterday saying that 80% of the F&O volume happens in India globally. So this is quite a large figure, but the SEBI stance has been that there is no market stability issue, there is no systemic issue because the margins are levied at peak level. It happens 3 times a day. So what's your take? This STT will have an impact. Will it impact markets? How will the market take it?
So one is STT is predominantly more on the delivery side, and we are now talking about more on the F&O side.
Correct.
So I don't think these two are going to be related. If they increase some kind of other transaction charges, then maybe there might be some impact. But I would say that we need all kinds of participants in the market. They lend depth to the market. They lend stability to the market. Obviously, we should not be encouraging naive and new investors to just be speculators.
Yeah.
So maybe there is need for some kind of oversight. But I would say that, as a participant in the market, we believe that we should bother about things which are in our hand. Things which are not in our hand, let them come as they come.
Right.
Because over the last 25 years, we have seen so many changes.
Yeah.
And a lot of changes in the near term appear to be very, I would say...
blips in the long term.
No, they appear to be, I would say, impediments to volume and all. But ultimately, market participants have benefited out of it. As you rightly said, there's been no defaults, there have been no liquidity constraints. The margining system from the exchanges and SEBI has been phenomenal. So I think all it needs is maybe, you start to ensure that the participants, particularly in the F&O side, are aware of the risks. Maybe you increase the entry level, margins or the ticket size to a little bit higher so that the 500,000 rupee investor doesn't come in there. But otherwise, we need liquidity. I think liquidity definitely makes the market more beneficial for everyone.
So any kind of escalation in tax on F&Os you think will have a
in the near term,
impact?
Definitely it will have an impact. But, these are all theoretical questions.
Sure.
We don't know what is going to come in what form. So I don't know how to respond to it.
Okay, fair enough. Okay, one predominant theme, post-pandemic has been this buy on dip. Every dip is bought into. And we have not even seen a 10% correction in markets since 2020.
Yeah,
right?
Last 49 months.
Does it make you nervous?
So I would say that there are 2-3 aspects to it. One is, the global markets have also been quite resilient post-pandemic. Second is fundamentals have also been improving post-pandemic.
Right.
So if you look at Nifty, on an FY26 basis, we are at 17.5 times, I think 17.3, 17.4 times PE. Which is maybe 5-6% higher than the 10-year average, but it's not like a euphoric 25 times, 30 times. On a trailing basis, Nifty is 22 times, which was the case even in 2020. So I think the gains in Nifty at least have mimicked the increase in the profit. Yes, as I said, there are pockets of smaller companies, some theme-based companies, which have gone through the roof. But otherwise, I think the valuations are pretty okay. As far as buy on dips is concerned, I think for the first time, Indian investors or retail investors are benefiting from their own country, which is a great thing. They have realized that if the economy is going to grow from 3.5, 3.7 to $10 trillion, then ultimately returns are going to be made. And this whole concept of SIPs has also ensured that every dip you have new investors coming in.
Yeah.
I think it's a welcome sign as long as I said, the investment is coming into fundamentally strong companies rather than tips and rather than some themes which might be too expensive.
So as a strategy, buy on dip works in a growing market. But tell me, are there pockets where you would today recommend you should actually utilize the peaks? It should be sell on peak than buy on dip.
So there are a lot of pockets, but see, every investor will have a different take on them. Maybe
what's your take? I want your take. Your expert take.
Peaks might be, opportunities for someone else.
Yeah.
So I do believe in fundamentals, and I am a little bit of a value-conscious investor.
Yeah.
So sometimes a good company or a good theme is not necessarily a good stock.
Correct.
And we have discussed in earlier also bubble and quality kind of stuff, and I think this is also happening now. So there are some public sector defense companies which are trading at 17, 18 times sales, not earnings.
Correct.
Earlier PSUs used to get 5 times earnings.
Correct.
Now they're trading at 17, 18 times sales. And it's not that they're growing like crazy.
Yeah.
Yes, the government announcements and all are pro-manufacturing in India. So it's a great theme. But, every stock has a value.
Correct.
So I think that is one space where we are feeling a lot of, I would say excesses. Same is the case with railways. You have anything to do with EVs. The moment you announce that we are going into EV, the stock goes up like crazy.
Correct.
Only announcement does not reflect into profit and so on and so forth. And then you have all these smaller companies which are coming out with IPOs, and I think there's a huge frenzy there.
Yeah.
So there is a lot of pockets where investors have to be really careful. And particularly if you're paying something which is like 100p, 200p without commensurate increase in profit, then someone is going to get stuck.
So Sunil, what is the new 15 for you? Because I remember, I think in 2021 or 20, we did this elaborate interview and you say 15%, 15 P is your 15 by 15 matrix is your 15% growth available at 15 times PE. But now...
So I would say the first two are still sacrosanct. We are still looking at 15% growth. We are still looking at a minimum ROC, ROE of 15%.
Yeah.
On the PE front, I think what we have done is, at least on the portfolio level, we are still sticking with that 1 year forward PE of 15. So far, we have been able to manage. But I'm very sure if the market continues to move the way it is going to be difficult. But even our take on the market, Mahalakshmi, is that, we are not going to see... So, but for
an average, sorry to cut you. For an average 15 on your portfolio, you will also need some which are below 15, right? That's how your average. So
some large private banks are now available at 11, 12 PE. It has never been the case. So there are pockets where, reasonable size companies are available at decent PE multiples. And, then you marry them with some, maybe a forward-looking PE, which is slightly higher, but the growth rates are high,
Right.
So you are able to still manage. The only thing I was trying to tell you is that last 3-4 year returns of 30, 35, 40% CAGR are not going to be repeated.
Correct.
So our view is that even if you have a portfolio today and the profit growth we expect for the next 2 years of 16%, even if you're able to make returns commensurate to the profit growth, we are fine. So our view is that in the next 2-3 years, the returns an investor should expect should be low to mid-teen returns. If you expect some fireworks beyond this, then you are in for disappointment.
And does this market make it difficult for active fund managers like you? I'm asking this question because, whenever you look at previous peaks, let's say 2007 or 1999, there was great polarity into, there were some pockets which are exceptionally priced, there were other pockets which were exceptionally cheap also. Now you don't see exceptionally cheap, you see exceptionally expensive and then, the middle range. So does it make it difficult for you as a stock picker?
Fund management is always difficult. When the markets are not doing well, there is always a confusion of what should we be doing. I think the difficulty now is because of our value bias. And more because, the momentum stocks keep on moving up on a daily basis. And because you're not participating always, there is going to be pressure on you. But as I said, the good thing is we have been communicating to our investors last 6 months that, there's been a lot of wealth which everyone has created. I think the next 2-3 years are a period of consolidation.
Right.
Even if you are able to generate, as I said, low to mid-teen returns without taking extraordinary risk, you should be happy about it. And I think our investors are very clear about that. And I think that reduces the pressure significantly.
Right.
But, we are in a rat race. We are there. We want to be among the best. We want to be better than our peer set. So pressure is always going to be there.
Right.
But again, even in the lecture or the study which we did yesterday, at least my take was that this is a time when you should know what not to do rather than what to do. So that is going to be very important. You have to resist doing what you should not be doing. I think that is going to be very, very crucial.
So tell us those
So I said, don't chase stocks just because the theme is good. You can't be paying 17, 18 times sales because that means it's like 100 P for segments which are, there's one customer, Government of India. So everything else is like against, except the momentum and the narrative and the news flow.
Right.
And there are a lot of pockets to it. Don't get sucked into very, very small companies which would be difficult to exit when there are fundamentals question about it. There are a lot of news flows which keep on coming up because in these kind of market, every company would want their market cap to be higher.
Correct.
Because promoters are interested in selling their stake. They want to raise money through the QIP route. There are so many IPOs lined up. Almost on a daily basis, you have one IPO coming up. So this is the time where you have to basically take more time to research and less to invest. I always tell to my analyst team that in a bear market, we end up researching much more than we should to buy small quantities of shares. And in a bull market, we hardly research and we end up spending crores and crores on investing because, you become a little more liberal.
Right.
But it should be the other way around.
Right. True. So, people who invest now, there is a lot of frenzy, like you also pointed out, in PSU stocks also. So, one thing I pick up from a lot of people is there are certain pockets. For example, power. Power people are still saying is, The stocks have run up exceptionally in the last 2-3 years, but a lot of them are still batting for it, saying that the business models are very strong. The power cycle in India will continue. And relatively, they're not, these are, it's not like the stock that you mentioned, right? The defense PSU. Do you believe in the power story?
So
has it run its course, or do you think there is more value there?
So one is, all PSUs are not in a frenzied zone. So, you also have to go back a little bit. So PSUs were down and out. They used to get P's, which was significant discount to the market P, because, there was this whole thing that PSUs are not great investment opportunities. Correct. Profit growth was not there because they were in sectors which were not doing well. I think what has happened over the last 3-4 years is twofold. One is they have also been growing in terms of their profit, commensurate to the private sector peers. Also, the P, which used to be very, very low, has come to decent levels. And that's why you see from the bottom, the stocks have moved up.
Right.
But despite that, there are pockets where a lot of PSUs still have room to grow and room to even generate returns. I would say PSU banks would be one space. Even some PSU metal companies, some PSU, energy companies, whether it is oil and gas or even metals this power related, there is still room to grow, because in all these segments, India has huge demand. So power, for example, if the economy grows at 7.5% real, I think power growth will be 10-12%. And suddenly, because of all this ESG thing, no one put up power plants, and now suddenly we are short in terms of peak deficit as far as power is concerned. So there is going to be opportunity. So I don't know whether they will make the same kind of returns they have given last 3-4 years, but I think profit growth is going to be good, mid-teen and maybe higher teens also.
So power and PSU banks, you're saying there is still value in the PSU pack. Okay, cool. Okay, your main hunting ground is mid-caps and small caps. And that's the segment that has done exceptionally well in the last 1 or 2 years. But this year, everyone has been saying that once the foreign money flows into India, the pocket that will benefit the most, because most of that money went away from large caps, it will also flow back into large caps. And that will therefore be the outperformer. Do you see that happening?
So one is, yes, we love mid and small cap, but we also have investment in large caps. The only thing is, we are investors.
That's a change in the last 2 years.
No, we always had. The only thing is, we say that we are investors, we are not allocators. So we'll not buy a large cap just because it's in the index.
Right.
Independently, that stock has to be of value to us. So we have funds which are like flexi cap funds or an all cap fund where 40% is large cap. So we have exposure there. On whether mid and small cap will be doing better than the large caps or not, I would say last 3-4 years, again, the difference between a mid and small cap return over large cap was anywhere between 10 to 25% on a CAGR basis. So if large caps doubled, mid caps tripled and small caps quadrupled. I think that difference is going to narrow significantly. There is no doubt about it, because this kind of difference cannot continue. But whether mid and small cap will give you slightly higher return than large cap, our view is still that over the 3-4 years perspective, they will give. In the very near term, 3 months, 6 months, I am not sure. But from a 2-3 years perspective, mid and small cap still have potential to give you larger returns. The only thing is, mid and small cap, you can't classify as a bucket.
Uniform basket.
Because there are some stocks, as I said, which are trading at 100p. And then there are some stocks which are trading at reasonable P multiples. So in mid and small cap, it is all going to be about stock specifics rather than, treating them as a basket.
Right. So, again, Sunil, we've had this conversation about, bubble in quality, especially consumer companies. Now, right after the election, there is this narrative that, government spending will all be towards consumption. So, anyway, the Nielsen report also showed some uptick in demand. There is rural recovery, good monsoon, all of that. And on the contrary, on the investment side, a lot of stocks, ABB, Siemens, Thermax, all of them are now triple digit. Some of them are in triple digit Ps. And the consumer guys, the proponents of consumer are saying that is, cyclical business trading at much higher. So mine is a value play in consumer. What's your take? How do you compare these companies?
Because beauty in the eyes of the beholder. Someone is buying them at 100p, what can you do? But having said that, I think, consumption in India is a great thing, because we are 1.4 billion people. I always say that right now, there are only 400 million people in India who can afford some wants. Billion are just struggling to meet their needs. This is going to dramatically change. In the next 10 years, you'll have 1 billion people who can afford some wants, which is a swing of 600 million people, which is equivalent to the population of Europe and US put together. So across segments, consumption is going to just go through the roof. But some change has also happened, Earlier, you and me, if we were brushing our teeth with one type of toothpaste, it was all year long.
Right.
That same soap we used to use all our lives. I think now we are willing to experiment. The other thing is there is staples in the consumer and then there is discretionary.
Right.
I think discretionary will explode, because as standard of living improves, you would want to spend money on discretionary. So discretionary space, I think there is going to be huge opportunity. And in the near term, obviously, because last 18 months, nothing has happened on the consumption side, there is a latent demand which is there, which will come into play. Obviously, April to June will be bad quarter because you had highest ever summer, extensive summer months. No one wanted to go out. You had elections, disruptions, weddings got shifted because of the two reasons. So April to June might not be a great quarter, but post that, you will have weddings and you will have all the effects of, as I said, election spending and MSP and all coming up. So consumption will look good. But, you can't give a 60-70 PE for a company which is growing at 10%. As we always have described that, you can give a 40-50 PE for a company which is growing at 30%. So I think that is where you will have to choose your stocks, I would say that staples growing at 10% don't deserve 60-70 PE even now, though they are much more attractive than they were 3 years back because they have had a 3-year time correction where the markets have doubled and these stocks are still there.
Correct.
So that trade has worked beautifully. I think now maybe if you are able to find some consumption plays which are reasonable compared to the growth possible, then it definitely makes sense because India to grow will have to have consumption also a major play in the growth story.
So another question on consumption is, Sunil, that, in the last 2-3 years, especially post-pandemic, this premiumization trend has worked very well. And now, there are thematic funds that are centered around this theme. Do you think that narrative will start to change now? Because one is the election verdict itself tells you that, a certain segment of the economy needs a bigger pull, bigger push. So maybe government will take some measures which will sort of change that equation. Naturally also, I think the other risk people talk about is the, jobs and the disruption that AI can possibly cause and what kind of effect will that have on, saving, spending, consumption, etc.
So multiple questions into one. Let me try and recollect an answer. So premiumization is here to stay. So I mentioned to you about discretionary spending. We are willing to experiment. We are willing to also spend. And I think that is going to be a theme, because India is again multiple countries into one. So there is an upper layer which is like super, super rich. I think so all kinds of luxury goods, there has been no slowdown in demand. And then there is this huge, as I said, a pool of population which is going to come into some kind of wants where they would, demand better clothes, better shoes and better everything. So premiumization as a theme looks set for the next 10, 15, 20 years. In terms of jobs losses and job creation, yes, AI is a black box. We don't know how it will pan out. But any new technology which comes in, at least in the initial phase, helps employment. Because if every company has to implement an AI strategy, they, at least for the start 2-3 years, they will need to have that whole ecosystem being built in terms of technology being created. And then maybe we don't know how the disruptions pan out. So that would be the case. In terms of jobs, I think that is where the government has been focusing a lot on this Make in India, because they also realize that for this huge population, we have almost 1.5 crore entrants into the job market every year. So to give them gainful employment, we will have to go in for manufacturing, we'll have to go in for some kind of job creation. And I think that is where the PLI, Make in India and all will come into play.
I know you are a bottom-up stock picker, but tell me 3 themes where your conviction level is highest.
So, frankly, I am very positive on India, and I have always been, as you rightly said, but in all last 25 years, whoever has been positive on India has had good wealth, good health and smiles on their face. But, if you ask me right now, I think private banks, it's a consensus trade, so maybe they will take some time to move. But given the current scenario, at 10 to 12 PE for really large franchises, and they are also the biggest beneficiary of consumerism.
Right.
Because, ultimately, if you make wealth,
Personal
you will have to
loans,
have
right.
this. Second, which is a subsector, is the asset and wealth management industry, where we are also a participant. So you mentioned about, premiumization and luxury and all. So the biggest beneficiaries are the asset and wealth management companies.
Correct,
Because,
correct.
if people start to have wealth, they're not going to spend everything. Indians like to save. So that is again going to be a big thing. And I would third say that selective consumers, which is unlike what we used to do, but selective consumer has a lot of opportunity. Obviously the challenge there is to pick stocks which are sort of in that value zone, but that also has a lot of potential. But ultimately, you have infra, you have pharma, which will all do selectively well.
Right.
But I would say if you just pick me on these three things, these would be the...
Okay. Top risks to markets.
So risks are always there. I would say visible risks are not too many. So geopolitical globally is always a risk, because the world is now run by too many very strong-headed people.
Yeah.
And there are a lot of egos all over the place. So whether it is Russia, Ukraine as a risk, or China, Taiwan, or Israel, Hamas, and this kind of risk will always be there. But these are unpredictable risks. I think on the predictable risk, you don't see anything, which is also scary, because if you don't see any risk, then there is a risk. But again, if you go back, major corrections in the markets have happened due to events which no one foresaw. So maybe that risk is something which we are not seeing right now. On the visible risk, I don't see major risk which will cause the market to fall like 15-20% on the horizon.
That's all from me, Sunil. Thank you so much for taking the time.
Pleasure.
Out.
Thanks for having me.
Thanks.